I'm Frank Kelly from KDA, and we're here today in Enniscorthy in the offices of Robin Financial to discuss all things auto enrolment, or as it's in the media at the moment, My Future Fund. I'm joined here today by Miles Robin from Robin Financial and Nathan Dunn from Zurich, just to have a general chat about how it's going to affect both employers and employees. First off, we're going to talk to Nathan, and he's going to introduce auto enrolment, what it is, and when it's due to come in, and how it's going to affect you as an employer.
Thanks, Frank. Essentially what auto enrolment is, it's a government-backed retirement savings scheme. Auto enrolment will impact roughly around 800,000 workers in Ireland. Anyone who's between the ages of 23 and 60, if they're earning more than 20,000 a year, will be automatically enrolled in the auto enrolment savings scheme. That's provided they're not already part of a pension scheme. That's facilitated through payroll, or if they're under the ages of 23 and over 60.
Just so auto enrolment is coming in, what's the cost going to be for the employers in relation to auto enrolment, which is due to come in from the 1st of January next year?
Yeah, when it comes to the contribution rates in relation to auto enrolment, initially it'll start at 1.5% from the employee, 1.5% from the employer, and it'll be 0.5% top up from the government. And you can see from the slide here that it will be over a 10-year period, and the overall aim of auto enrolment is to eventually get, after 10 years, it'll be 6% from the employee, 6% from the employer, and 2% top up from the government.
Yeah, so it's going to be a big cost to employers, and I suppose at the moment a lot of employers aren't considering it, aren't looking at it, or haven't probably run the figures on it from their end to actually see what this is going to cost from the 1st of January forward. I'll just turn to Miles here then. Miles, I suppose we're nearly at the end of August, so we've 4 months to go until it's going to come in. What are you seeing on the ground then as a broker, the type of clients that you're dealing with, and the kind of advice then that you have for people that are coming to you on a weekly basis in relation to this?
Thanks, Frank. We're kind of, I would say, beating the drum for about the last 12 to 18 months, and it's only really since the government announced it, passed legislation, I think about 3 or 4 months ago, that really we're starting to get traction. What we found is there is a stat out there that there's 800,000 people that are going to be will commence pensions from the 1st of January. They reckon 80% of them are on the lower rate of tax, and 20% of them are on the high rate of tax. So to relate that back to us, what we're finding is that there are certain people are contacting us, and we're advising them that the auto enrolment government scheme is the best option for them. If it's low salaries, they're transient, they wouldn't be in a self-employed basis, but they're earning more than 20,000. But what we're finding is with the employer side is that for key employees especially, and these are the guys that are predominantly on the high rate of tax, they need advice around pension planning. They can't contribute any more than 1.5% through the government scheme, employer and employee. Through a private scheme, the employer can contribute more, the employee can contribute more. So to come back to my area around our interaction, is what we're finding is that really 1.5 and 1.5 in the private side for people on the high salaries really won't give them. Now, we might change this in a second. Be careful what I say here, right? I'll come back to that in a second, because I'm not trying to discriminate against anybody here. But really, that's where the advice side comes in. Again, for proprietary directors who are employees of maybe a husband-wife situation of their own company, and they're not in a pension scheme, they have to do a pension. So really, auto enrolment, I think, is good. I think you're going to end up in a situation where there's people now who are retiring, haven't got pensions, but by 2050 onwards will have pensions. But again, we're finding on the 20% of the people that are on the high rate of tax, there's one area which is hugely important to the employee side, is that on the government side, they'll get 25% of an extra contribution, which in theory is the tax relief, but through a private pension, the employee will get 40% tax relief on the contributions. So what we're looking at and what we find is people are going to be auto-enrolled probably in January, and then they're going to realise, oh, I can only pay 1.5, and I'm only getting 25% tax relief on my contribution. And we feel next year there's going to be a lot more interaction with us. But I think the big thing is speak to a professional, speak to your broker, do your research, and try and really ascertain, is it an auto-enrolment is best for my employees, or some or all of my employees, or is it better put in a private pension scheme? That's where we come in. And a lot of it is advice. And the one thing which the auto-enrolment scheme, and it's one of the negatives, is there'll be no advice. People will start to contribute into the scheme, and it'll be managed by 4 fund managers. There'll be a low risk, medium risk, and high risk approach to the investments. But what I would say is, on the 20% of the people who are on the high rate, the key thing is the engagement of a professional that advises people on risk, on contributions, and is really there to manage them through the whole process prior to retirement and at retirement. And in an auto-enrollment situation, that's not going to happen.
Thanks, Miles. So when we're looking at auto-enrolment, then there's obviously going to be the cost of the employer. So the cost of the employer is going to be 1.5% for the first 3 years. But what about the employees then? So I'm just going to hand you over to Nathan then, just to discuss the pros and cons when it comes to employees and them deciding whether they go into a private pension or wait for auto-enrolment.
Thanks, Frank. Yeah, look, I suppose when it comes to the employees, there is a few things to consider, particularly if we compare auto-enrolment to a private pension plan, for example. So I suppose some of the differences really between auto-enrolment and a private pension, it comes down to a few things. Access in auto-enrolment is actually restricted to the state pension age. So that's currently 66 at the moment in Ireland, whereas with a private pension plan, access is generally from age 60 or potentially from age 50, for example, if an employee leaves service or if they decide to retire early, for example. I suppose another key difference between auto-enrolment and a private pension would be the ability to do AVCs. So what AVCs are, they're called an additional voluntary contribution. That's something that an employee can do. So to use a simple example, if I'm part of an employer's pension scheme and my employer is contributing 2% and I'm contributing 2%, I can do as an employee what's called an additional voluntary contribution, for example, an additional 2%. That facility is not available currently in auto-enrolment. Again, then, when we look at a private pension scheme versus auto-enrolment, again, just to allude to Miles' previous points, is that there's no advice in auto-enrolment, whereas there is advice in private pension, particularly around also the investment piece with auto-enrolment. As we said already, there will be 3 fund managers involved. It will be a default investment strategy, whereas if an employee decides to take part in a executive pension plan or even a PRSA, which is a personal retirement savings account, they'd have a wide range of investment choices through all different providers in Ireland. So I think it's important from an employee's perspective that employees do understand that there is alternatives to auto-enrolment out there in the form of occupational pension schemes and PRSAs, particularly around the advice, the investment and the access to private pensions.
Thanks, Nathan. You touched on AVCs there. So just around obviously I'm an accountant, so around the tax aspect then when it comes to auto-enrolment, can you give us the difference then from a tax perspective on someone that's paying into a private pension versus someone that's automatically enrolled into the auto-enrolment?
Yeah, thanks, Frank. And I suppose just to give a simple example really is anyone who is a higher rate taxpayer. If you're in a private pension scheme and you're a higher rate taxpayer, how tax relief will work is for every €100 you contribute, because you're on the 40% tax rate, that'll equate to a net, sorry, we might just go back on that one again. Yeah, thanks, Frank. So just to put it in simple terms, anyone who's on the higher rate of tax and contributing to a private pension scheme, for every €100 they put in, they'll save €40 in tax relief. So the net cost to the employee is only actually €60. If we compare that to auto-enrolment, it's not tax relief as such in auto-enrolment, but to equate that in tax relief terms, it'll work out at around 25% relief. So again, just the message is that anyone who's on the higher rate of tax, from a tax relief perspective, a private pension scheme would be much more beneficial would be much more beneficial compared to auto enrolment.
So next question we have is, who is exempt from auto enrolment? So we'll get Nathan again just to answer this one.
Thanks, Frank. Yeah, look, I suppose in terms of being exempt from auto enrolment, anyone really who has a pension scheme in place that's been facilitated through payroll, those employees will be exempt from auto enrolment. But it is an important thing to touch on, because there is people out there who pay into pensions themselves through their own bank account, and they'll claim tax relief through the revenue themselves. It's actually those people who will need to give auto enrolment consideration, because they'll actually be automatically enrolled. And the reason for that is because they're paying into a pension. Yes, they're paying into it themselves and they're claiming tax relief, but because there's no deduction going out through payroll, they'll be automatically enrolled in auto enrolment, because the agency, which is known as NERSA, they won't have the ability to access that individual's obviously private bank account, and therefore, because there's no deduction going out through payroll, they'll be automatically enrolled in the auto enrolment pension scheme.
Just to recap then, Nathan's point is that if you are a person who pays your own pension through your own bank account, and there's no deduction on your payroll for that pension payment, that you will automatically be opted into auto enrolment, even though you already have an existing private pension. But unfortunately, the way the system is going to work with NERSA is that once the payroll is completed and uploaded to the revenue, if there is no pension deduction on your payslip, then NERSA doesn't know that you're already paying into a private pension scheme. So then at that stage, you're going to be automatically opted in to the auto enrolment. So stemming from that, then the next question to Miles is, if I have a private pension that I pay on my own bank account, and then I'm automatically opted into the auto enrolment because there's no deduction on my pay slip, what happens then, I suppose?
In the experiences that were happening, what's happening from our interaction with clients is, our advice to them is to stop their existing pension that they're paying through their bank account, speak with their employer, see will he'll have to allow and facilitate that payment to be paid through payroll. He has an obligation to match that at 1.5% of the gross salary. The pension that's made paid up, you don't lose that; it still stays invested. But that's where the advice part comes in, where we can advise the client on risk. We can include that within their forward planning for retirement. And what we're finding as well in our interaction with people in different sectors like IT or areas around where people move jobs a lot, is they have multiple pensions and they have deferred. This would be another deferred pension that they would have. So we've had situations where clients have had 4, 5, 6 deferred pensions. But what we as advisors, for us to do our job properly, is to get information on that, get valuations, assess the risk, and really it becomes part of their overall planning for retirement, because an existing pension will continue to grow, it will continue to be invested, but you wouldn't be contributing to it. So I think it comes back to my earlier point. It's all about advice around, what you have, what you can contribute. And the key thing as well is auto enrolment is 1.5 and 1.5. If you're contributing currently in excess of 1.5%, you can continue to do that through a private pension, but you can't do it through auto enrolment. Back to you, Frank.
What about self-employed individuals then? What is this going to affect their obligations under pensions legislation, or how will they be affected going forward from January?
Thanks, Frank. I suppose just to put it simply, auto enrolment will not apply to self-employed. It didn't work in different jurisdictions, so it doesn't apply to self-employed. But I suppose just to elaborate a little bit more on that point, it is important for anyone who's self-employed, if they do have an employee working for them who's PAYE, provided they meet obviously the criteria, i.e. Between the ages of 23 and 60 and earning more than 20,000 a year, they will be automatically enrolled in auto enrolment. So again, just to summarise, it doesn't apply to self-employed. but it's definitely a consideration for those who have PAYE employees on the books.
Okay, so I'm here on the 1st of January 26. I'm an employee, I've been opted in. The question then is, how do I get out of auto enrolment? So back to Nathan on this one again.
Yeah, with auto enrolment, there will be an opt-out facility. So employees will be able to opt out after 6 months. It is important, though, that employees do realise that yes, they can opt out after 6 months. However, they will be automatically re-enrolled every 2 years. So yes, you can get out, but you will be automatically enrolled every 2 years.
The next question then, just leading on from that, is if I opt out after 6 months, do I get my money back? Does the employer get their money back? Maybe Miles, you can elaborate a bit more on that.
Thanks, Frank. Excuse me. No is the question. If you opt out after 6 months, your contributions are employer and employer locked in. After 2 years, at the 3% contribution, you opt back in. But if you, as an employer, was to put in place a master trust group pension scheme, for the employer, if the employee leaves, there's no opting out. But if the employer was to leave within 24 months of joining the scheme, there's a full refund of contributions back to the employer. And on the employee side, if they leave the scheme again before 24 months, they have two options. They can take a transfer to a new pension, a new private pension or group pension scheme, or they can take a refund of contributions minus the tax that was paid tax relief that was claimed at source on contributions. So what we're finding from an employer side, the relationship can be better from the point of view of an employee might think twice maybe of moving employment because he might lose his pension contributions at that stage. So it's engagement back where rather than the employee making the decision to go, he might speak with the employer prior to making the decision, and that might give the employer an opportunity because of maybe him losing the employer contributions for the period of time when he was employed. So I think it's key. It's something that doesn't apply in auto enrolment, and it's something that it's called vested rights, and it's something that we recommend and speak to all employers that are putting pension schemes in place and the importance of it.
So now I get to 66, 67, 68, and I'm going to retire. What are the differences then on drawdown between an auto enrolment pension scheme and a private pension scheme?
Yeah, I suppose at the moment with auto enrolment, there's actually no post-retirement vehicle in place for auto enrolment. So what will happen is 25% of the fund will be paid out as a tax-free lump sum, and the balance will be paid as a taxable payment. Whereas with a private pension plan, the most common drawdown approach we would see is 25% of the fund, again, taken as a tax-free payment. But with a private pension, there's an ability to purchase what's called an approved retirement fund, or an annuity with the balance. But again, it really does come back to the advice piece, speaking to a financial advisor. Is the ARF option better for you? Is the annuity option better? But again, it just really comes down to advice. Yeah.
If I'm a company director, what are my options when it comes to auto enrolment? And Nathan's going to answer this one.
Yeah, I suppose, really when it comes to company directors, it is important, particularly if they're drawing a salary from the company, that they are effectively an employee. And again, once their salary meets the requirements for auto enrolment, if they don't have anything set up, they will be automatically enrolled. So rather than be automatically enrolled in auto enrolment, there will be, I suppose, really two options for them. Set up a company pension plan, pay the contribution through the company, or set up what's called a personal retirement savings account, or a PRSA. And again, there's an option to pay that through the company as well.
Just to recap then on the pros and cons of auto enrolment from Nathan.
Yeah, I suppose, in terms of the pros really of auto enrolment, I think, what it will do is it will create awareness around pensions in Ireland, and I think that can only be a good thing really. There's definitely an inertia when it comes to pensions in Ireland. So look, again, the positive there would be that we'll increase awareness around that. Like, we do want people to save for retirement. I think an interesting statistics around Ireland's population is that we most definitely do have an ageing population. It is estimated that 1 in 4 people in Ireland will be aged 65 or more in the next 25 years. So I think creating that pensions awareness with auto-enrolment can only be a positive. In terms of cons, really, I suppose the restricted access in terms of state pension age is definitely a con if we compare that to a private pension. Again, in terms of tax relief, particularly for those on the higher rate of tax, being able to get 40% relief in a private pension versus 25% in auto-enrolment is definitely one of the cons. And I think really another, I suppose a con really when it comes to auto-enrolment is definitely the lack of advice. So again, that would be kind of some of the key cons in relation to auto-enrolment.
Over to Miles now for some pros and cons of private pension schemes.
Thanks, Frank. I suppose one of the key things around the private against auto-enrolment, and repeating what Nathan said, is the tax relief, but I think it's the engagement for the employer and the employee around pension planning. And there's a huge lack out there of, there's been so much legislation change in the last couple of years around pensions. It's actually properly understand what pension scheme I have currently, what pension scheme I should be in. And it comes back to really, you need to sit down with a professional, a broker, your bank, and really understand what's best for you, the proprietor, or if you're working on behalf of your employees, what's best. And really, you need to point them in the direction of somebody that really understands what's. I've gone on a rabbit hole there. I've kind of lost my train of thought. But I suppose the big thing really is, is advice, and really properly getting the best advice. And the 1.5% on one side is good, but if there is a facility there for an employer to pay additional contributions or employees to pay additional AVCs, the more that goes in, they'll have a higher pension fund, the better options they'll have, and that's key to it. I think auto-enrolment is a good thing. There's 600,000 people that are going to have pensions that never had pensions before, which is positive. But, there's a certain criteria of the population that are not in pension schemes that need advice, and that's where your broker comes in, or your bank.
Just to close off the session then, last word from you, Nathan, just to close it off.
I think just to kind of close off, just when it comes to auto-enrolment, look, it will definitely increase awareness around pensions in Ireland, which can only be a good thing. There's definitely limitations when it comes to auto-enrolment, as we've discussed today. So I think an important point just to take away from today is to just seek advice. Seek advice in all aspects. Is auto-enrolment suitable for you, or is it more suitable to take part in a private pension scheme, whether that's an occupational pension scheme or a personal retirement savings scheme, for example?
Thanks, Nathan. And Miles, then finally, last word from you.
Again, just following on from Nathan, I think it's a good thing. You're going to have people who are not in pensions are going to be in pensions, but just looking at the whole cost of living crisis that we're in now, and clients that are coming into me, you're looking at people in their 60s and 70s, and they're living currently maybe on 2 old age pensions, which are contributory or non-contributory. I think they're going to find it difficult to be able to put food on the table in 20 and 30 years' time. So what's important is auto-enrolment will be a plus, but in certain situations you're going to have people, maybe for tax reasons, should be paying more. They might be able to encourage their employer for salary reviews to pay more. It comes back to, again, it's advice around if you're an employee, what's best for you personally, or again, if you're an employee, what's best for your employees. And from the employee side, speak to your financial advisor, or else speak to your employer, have a plan. And that's where I would say is vitally important. But the one thing that you can do, if you join auto-enrolment, there will be an opt-out after 6 months, and a 2-month window that if you want to seek a different option through the private sector, that is available, and that will happen from 6 months from June next year.
Thanks, Miles. Thanks, Nathan, for that today. For me, the biggest takeaway here is timing. When it comes to tax advice, when it comes to anything we're doing, it always comes back to timing, and we always say, look at it early and try get early adoption. Don't come to your broker on the 20th of December when he's closing the door for Christmas looking for some advice around this. Seek advice early and get it boxed off, and when it comes to January, then you don't have to worry about it. So thanks to the lads for today.
Yeah, so I was delighted to sit down today with Miles Robin and Robin Financial and Frank Kelly and KDA to discuss all things auto enrolment. I found today's event very insightful, and I look forward to the introduction of My Future Fund in January 2026.
Just to finish up here, I'd just like to thank Frank Kelly from KDA and Nathan Dunn from Zurich about their few insightful words on auto enrolment. What I would say is Robin Financial, if you Google us, if you're looking for any advice at all around auto enrolment, don't hesitate to pick up the phone, give us a call, send us an email. We're here for you, and we're independent. We're in existence in Wexford 98 years at this stage. So what I would say, give us a call and we'll help you as best we can.
Big thanks to Miles and Nathan today for their very insightful information in relation to auto enrolment, private pensions. I think it's really important that we as business owners actually learn about it and understand the implications it's going to have on us from a cost perspective, but also on employees and how we can leverage both auto enrolment and private pensions to actually retain staff and actually make us more competitive when it comes to attracting staff. And having a really good pension scheme can actually help both retain and attract really good employees when we're in such a labour shortage at the moment. So I think it's really important to understand it, and as Miles said, reach out if you need any more information about it.